And welcome to the 19th meeting of the Public Audit and Post-Legislative Scrutiny Committee in 2020. We've got apologies from Anna Sawa, MSP, who's the acting convener, and therefore, by popular demand, I'll be convening this meeting in his place. And before we begin, can I remind members, witnesses and staff present that social distancing measures are in place. The witnesses who are miles away from me have already realised that, and across the Holyrood campus. I ask that all care is taken to observe these measures over the course of this morning's business, including when exiting and entering the committee room. And can I remind members not to touch the microphones or consoles during this meeting. So agenda item 1 is a decision on taking business in private. Do any members object to taking item 3 in private? And if Neil Bibby, Alex Neil or Willie Coffey object, can you please raise your hands? And I've got no objections to that, so that is agreed. So agenda item 2 is on the section 23 report, privately financed infrastructure investment, the non-profit distributing which is NPD and hub models. Can I welcome our witnesses to the meeting today? We've got Peter Reiki, Chief Executive, and Kerry Alexander, Director of Infrastructure, Investment, Finance and Programmes, both from the Scottish Futures Trust. You're very welcome. And Dr. Jim Cuthbert, who's an independent statistician and the former Scottish Office Chief Statistician. You're welcome as well, Jim. So I understand that both Peter Reiki and Dr. Cuthbert wish to make some brief opening comments, so could I ask for Peter's first?
Thank you, Convener, for the opportunity to give evidence to the committee today on the report published by Audit Scotland in January. First of all, I'd like to record the fact that I act as a public interest director on the company delivering the Aberdeen Western Peripheral Route MPD project. And Kerry?
Public Interest Director for the project NPD company that runs the Inverness College project. Also was on the advisory panel for the Audit Scotland report.
Thank you. And Scottish Futures Trust acts as the central programme managers for the HUB programme, which has delivered over 130 community infrastructure projects using capital funding, as well as the 41 projects delivered by the programme using privately financed approaches, which we're here to discuss today. We also manage the programme of 10 non-profit distributing, or NPD, projects undertaken since 2011. And together, the revenue-funded programmes have delivered just under £3 billion worth of infrastructure investment in Scotland's roads, health and education facilities since 2011, as the report points out. And as the Auditor General has recognised, the programme has delivered additionality of investments in these assets, and the whole life costs of the contracts have all been published. These show that the total programme cost is projected to be within the affordability cap of 5% of future DEL budget set by the Scottish Government and is below the early estimates of the lifetime costs for the programme. SFT has also published all of the NPD and HUB DBFM contracts and is publishing the financial models following a period of commercial confidentiality so that the interested parties can undertake their own analyses of these contracts and financing approaches. The report focused on the choice and cost of financing, and that's a very significant component of the asset's whole life cost. However, it's just one element of the value. Both the MPD and HUB programmes are early examples of a focus on community benefits. The HUB programme alone has delivered over 1,000 apprenticeship places and over 6,000 work placements, and over 80% by value of the subcontracts placed have gone to Scottish SMEs. And finally, all of these contracts include for asset maintenance. The payments made and the contract signed will keep the building or road in good condition for its users for the whole 25 to 30-year life of the contract. These community benefits delivered and the assurance of a good standard of maintenance are something I'm proud of across the programmes and are not something we have such good transparency over or assurance of in other forms of procurement. Of course, myself and Kerry will be happy to answer any questions you have.
Thank you, Peter. Can I ask Jim Cuthbert to say a few words?
Convener. And thank you for the opportunity to give evidence to the committee. I think the Audit Scotland report is very much to be welcomed. And one of the things it does is confirm the need for better understanding and better information about various forms of private finance model. But what the report does not do is to say how this should be achieved. And I think this committee has a potentially important role in achieving better information. What I suggest this committee might be doing or should be doing is, first of all, to identify the information requirements for this type of scheme, and secondly, to make recommendations about the kind of mechanisms which would deliver those requirements. I made some suggestions on both aspects in the note which I put to the committee, and I hope you'll consider these. Thank you.
Okay, I'm going to open it up to questions now, and I think my first one would be to just ask Dr. Cuthbert just to expand on what you've just said, if you could. It's probably for my own benefit because I'm quite new to the committee.
Right. Well, okay. I'm particularly interested in the financial costs of the financial aspects of the of these schemes, and I take on board what Peter is saying, that there are other things come in as well, and that's very important. I agree. It's very welcome that Scottish Futures Trust have taken a fairly liberal approach towards making information on the financial aspects of these schemes available. And they have this policy of publishing the financial model 2 years after the end of the construction period, and that is to be welcomed. And I published a paper in the Fraser of Islander which analysed the financial models for 3 hub schemes and drew some conclusions. One thing to note is that it's not easy to analyse these financial models, and that leads to the thought: wouldn't it be much better if when the project was being tendered for, one of the criteria which was laid down was that certain standard indicators should be produced for each project as a matter of course. That would make it much easier for everybody involved, SFT, outsiders when they get their hands on it, the public sector client, to understand what was actually going on. It's important that there is quite sophisticated information available. It's not just a question of the interest rate being charged on senior debt or being earned on subordinate debt. It's also important that there's information available and analysed on the profile of payments through time. And this is where I originally started to have an argument with Peter a good long while ago, where Peter quoted to the committee the weighted average cost of capital, which is just a straight weighting together 90%, 10% basically of the costs of senior and subordinate debt. And the point I was making was that given that your subordinate debt is actually being paid off much later for a variety of reasons than the senior debt, the actual cost, the internal rate of return of finance could be significantly larger than the weighted average cost of capital. And that indeed turns out to be the case, confirmed both in work I did and also in the Audit Scotland report. If that difference in time profiles means that potentially the value of the holdings of subordinate debt to the equity holders, if they came to make a secondary market sale to realise a profit, could actually be quite large. And to understand that, you really need to know what the net present value of the stream of projected payments on subordinate debt is, calculated at a discount rate which a pension company would be looking for if they came to purchase it. So you don't get an understanding of the potential profits which are made by the equity holders unless you have information on the net present value of that stream of payments calculated at an appropriate discount rate. You also don't really know about the opportunity cost to the private sector, to the public sector, unless you know what the net present value of the overall stream of payments that they're committing to make when they sign the contract, taking out that element which is for ongoing maintenance and services, etc., discounted at the sort of interest rate they would be paying if they'd gone down the National Loan Fund route. So I think it's essential that or very important, that the public sector has an idea of the opportunity cost, and one way of doing that is discount the unitary charge apart from services at an NLF discount interest rate, and potential profit to the private sector, which you get by discounting the subordinate debt payments at the sort of interest rate which a pension fund would be purchasing at. So these are the sort of indicators which should be being produced. there's no reason why these cannot be calculated from the financial model, although it can be difficult because all financial models are different. So there's absolutely no reason why they shouldn't be stipulated as a standard indicator which should be produced. And they should be produced as part of the documentation before the contract is signed. That would be of value, I think, to Scottish Futures Trust to be able to look at these aspects much more easily than they can do at present. It would be of value to the Scottish Government, obviously. There's no reason why, after the 2-year period of confidentiality is up, that these indicators should not be published so that the public knows. But in the shorter term, I suggest that if there's enough projects, it would be quite possible for Scottish Futures Trust to aggregate these indicators and publish an average over a year or 2 years so that we have an idea of what is going on currently, or more or less currently, of these projects. So that's the sort of suggestion I'm making, that there should be these mechanisms and that these indicators should be published.
Okay, so that was quite a long answer, and I think before I move on, I should give Peter Reiki the chance to give a response to that.
Yeah. First of all, I should say that these projects are competed, and the cost of finance is one aspect of the total cost of the project, which is paid for by the public sector in the form of the unitary charge over the 25 to 30-year life of the contract. And the critical aspect that we've always been really clear on and transparent on is what is the whole life cost of the design, build, finance and maintain of this asset through the contract. So that's the aspect that is studied in competition, and the best value is selected at that stage. So we agree with Dr. Cuthbert that there are lots of different ways of measuring the financing costs and different elements of the financing costs and different elements of all of the other costs involved in a large and complicated project. We think the primary one is the unitary charge, the overall cost to the public sector, and that has always been published. We have said, we wrote to the committee in September 2018 with both WACC and the IRR measures across the programme, and we've said that those are both useful indicators, both the WACC and the IRR are useful indicators, and we will happily commit to publishing the WACC and the IRR for contracts signed in the future, if there are any contracts of this nature in the future, because both are important measures. And as Dr. Cuthbert said, we could do that as an average updated on a periodic basis, and also individually for contracts when the period of commercial confidentiality, which again, as you said, we managed to keep quite tight once that's come to an end. We do think, however, that the range of other indicators that Dr. Cuthbert suggested, including those that include an estimate of a rate that a pension fund might be prepared to invest, are a bit more difficult, and that they involve an element that different people could take different views on, and therefore independent researchers or any other interested party are probably best off forming their own view of those sort of measures from the full information that comes in the financial models as and when they're published.
Okay. Colin Beattie wants to ask something.
I was just curious on something that Jim Cuthbert said there. I mean, you were suggesting that we use the measure IRR. I wondered why you hadn't considered maybe MIRR, which might give a more accurate figure and would certainly be it would indicate a little bit lower return against capital at the end of the day, which would have a beneficial knock-on effect, I think.
MIRR
MIRR
stands for?
Modified Internal Rate of Return.
Right. I mean, there are a number of different variations of internal rate of return, and I'm not saying anyone should specifically be used. Well, I do think, though, to come back to what Peter was saying, that knowing any variety of interest rate is not enough on its own, and one really has to get at net present values before one understands what is going on. And I'm not convinced by Peter's view that this might be, in some sense, difficult because there's a matter of judgment involved in choosing what interest rate to work on. one would be quite clear that, obviously, getting a particular interest rate to discount at would involve judgment. But on the other hand, one only needs to be in the appropriate range, in approximate range, to get a good idea of what is happening. I remember there was a program on PFI by Panorama, and they were looking at the interest rates involved, the IRRs being earned on subordinate debt and PFI schemes, and they contacted the head of one of the major PFI finance companies and asked what interest rate he was getting, and he said, I think it was 15% or round about that, which was within the range that the Treasury regarded at that time as being acceptable. But when we asked when we said to Panorama they should go back and ask what interest rate was being looked for, the target interest rate of their secondary market investors, and we had thought that that was the interest rate around about 8%. He came back and said it was around about 9%. But that really made no difference. 8 or 9% made no difference to the basic calculation. When you discounted at 8 or around 9%, you saw that the return that was being got on capital was multiples of the original capital being put in. So you don't need to know exactly the interest rate in the secondary market. There's always a good feel for what it is near enough, approximately, and you can do the calculation at that value. So I think that's, net present value at some realistic interest rate is a much more informative measure than any version of IRR or specific interest rate.
Okay, thanks for that. I'm just going to ask about the section in the report. It's from the summary, which deals with essentially transparency around how we decide or what form of financing to use for individual projects. And we can just read from that. It says it's not clear enough how decisions have been taken about which projects will use private finance, or how well this is achieving the best balance of costs and benefits in practice. So I guess that's a question for the SFT. How would you respond to that?
Well, SFT publishes, and in our report on MIM, we've set out a number of, that's the mutual investment model, which could be used in the future. We set out a number of characteristics of projects that make them either more or less suitable for delivering this way. And those characteristics include the scale of the project. It needs to be a reasonable size, at least 20 to 30 million pounds. It works very much better for new build projects rather than for any form of refurbishment. And there are certain classes of building and other assets that it's been well tried and tested for in the past, such as education buildings, colleges in the MPD programme, health buildings, hospitals and health centres, and indeed roads. So there are a set of known characteristics that make projects more suitable, but the decisions on which projects to finance in different routes is a decision made by the government, and therefore I think the recommendation that Audit Scotland made on that the need for increased transparency was a recommendation for government in that decision-making process.
So before I bring Alex Neil in, so are you saying it's entirely the government's choice? You've got nothing to do with it?
We set a set of characteristics, and we're able to help analyse projects that are priorities for investment against those characteristics. But the decisions that are made against that and which projects are financed different ways, the final decision is a decision that's made by government. Okay. Alex Neil wants to come in. Alex?
Thank you, Convener. I mean, obviously, a lot of this is highly technical and probably way beyond many of us in terms of the arguments about specifics, how you measure the internal rate of return and so on. I think the key issue for the committee, and I would like Jim and Peter's comments on this, the key issue for the committee, and I think probably the key issue for the Auditor General, is to have the information and the appropriate measurements to ensure that the taxpayer is getting value for money and that the taxpayer is not being ripped off. Now, a lot of this arises from the concerns. I mean, it all started in big time when Hare Myers Hospital, which was a PFI project, predated the Scottish Futures Trust. But we paid for that something like 4 times over. Meantime, the original people who were involved in the PFI contract have gone off and made hundreds of millions of pounds profit from the sale of their share, as it were, in this hospital. So what I want to know is, how do we not only make sure we get value for money today, but how do we make sure that we're not going to be ripped off and other people are going to walk away making massive profits from selling on their participation in these programs?
So that was directed at both of you, so you both get a shot. And if you can keep your answers fair, as brief as you can. Kerry.
I'll take that one first. Certainly in the NPD contracts, they do cap profits to private sector investors. So the value that's locked in when the project is signed is the value that is locked in. There are different points during the transaction when you have primary investors who take the upfront bidding risk on a project. They see it through the risky construction phase, and sometimes when they are coming out of that end and into the operational phase, actually you'll find a secondary investor who looks at the project and considers that there's real value in a long-term set of income coming through, so like a pension fund or an infrastructure fund, which tends to be backed by a pension fund. So they will pay a premium to receive that future set of cash flows. It's the same value that's within the contract. It's just that it's the shape of when the return is being taken out relative to the riskier phase and the longer, steadier operational phase.
Jim?
Yes. I mean, I don't want to repeat myself, but you cannot tell what the potential profit that will be taken out is unless you do an appropriate NPV calculation at an appropriate discount rate. It is perfectly obvious from the financial projections themselves, which are available actually before the contract is signed, what the potential profits are, assuming that the build, etc., goes through as planned. If a private investor after 3 or 4 years is taking out 2, 3, or even sometimes 4 times what their original equity investment was, then surely that should be ringing alarm bells early on that perhaps there is undue fat built into this contract. You cannot rely upon the competitive process alone getting that fat out, because the process, in fact, is not all that competitive, and what is happening is obscure. So there is information there which is readily available, readily recognizable, which should be being looked at. And I would say it's essential to look at it. And just to quote interest rates, I mean, the original flaw on PFI was the Treasury said a return of 15% or so in equity would be fine in the conditions of the day. They didn't realize that that return was being projected to be paid very heavily end-loaded towards the end of the contract period. They didn't realize that the effect of that was when you discounted at a discount rate of around 8 or 9%, you would get multiples back of your original capital. So the potential profit there was huge. And just to look at the unitary charge and say we can afford that, it looks to be value for money, is not good enough. You don't really have any idea of the potential profit which is there. And to say that the profit is capped, if the profit exists through the potential sale in a secondary market, then you can't cap that in any meaningful way unless you know exactly what the net present value is at a reasonable discount rate.
Well, so basically, I think I take it from those 2 answers, convener, that we're agreed on the need to cap excess profit. The question is, do the existing arrangements satisfy the ability to do that? And from what Jim's saying, basically the answer is no, we need to go further and value and the other matters. And I think that really is the issue for the committee and for the Auditor General, because clearly our job is to make sure that the taxpayer isn't taken for a ride. And if we need to put in additional measurements and additional conditions in order for that to happen, it seems to me that is a reasonable proposition, although I would like the advice of the Auditor General on precisely what those additional measures would be. I do have other questions to raise, but at this stage, that's the only point I wanted to register, because it's very relevant to the introductory remarks from Jim and Peter.
Okay, thanks for that, Alex. Yeah, I mean, I completely agree. It is about getting value for money for the taxpayer, and Peter Reiki wants to come back on that.
We agree that it's about getting value for money for the taxpayer, and our view, and the view that has always been taken through the procurement of projects, is that the way to get value for money is by having an open tender and a competitive procurement, and accepting the best combination of quality and cost to meet the user's requirements. And the cost that in an MPD or a hub DBFM project is the unitary charge over the life of the contract. So all of the tenders are based on that that type of competition to obtain that measure of life cycle value for money for the asset. Where we also agree is that that includes a cost of finance, and that the financiers have a fixed stream of future income that comes from this project that's part of the unitary charge. Where we have a difficulty is that we know that different financiers will trade that future stream of income at different points in time because of different views of risk and the markets at a point in time. We don't think that there's a particular measure of value about the opportunity for future trading of that debt instrument, if you like, because the competitive market will give us the best deal on offer at the time, at the outset. So we find it a little difficult to think what we would do differently in a competition that's about delivering the best unitary charge if we had that further information, which, as Jim has said, it is possible to calculate lots of things at that stage. We don't necessarily see how that would enhance the value that we would get as the best life cycle cost for that asset, which is the unitary charge summed over the life of the contract, versus the quality of the asset and the service that's delivered from it.
All right. Well, I want to bring other members in. So Bill Bowman, and then I'm going to go to Colin Beattie. And just remind the members who are not present in the room, if they want to come in, let me know through the chat box. Thanks. Bill.
Yeah, thank you, Convener. Good morning. I always remember being taught that money has a time value, and net present value gave you a good indication of that. And I just also like to mention, I think, as I did in the original discussion we had with the Auditor General, as far as I understand, that there's nothing illegal about the secondary market. It's just part of the way of the system works. But in the Auditor General's report, Exhibit 2, if you're familiar with that, which says how privately financed contracts work, it shows the parties, and I'm sure there's some very smart brains in these various lenders and contractors. But to use Alec Neil's phrase, I mean, who is responsible for making sure that the public are not taken for a ride? I don't see the governance overview in this.
Who's that directed to, Bill?
Both, I think, please. Yes.
I think, in a sense, everyone is responsible. I think that the public sector client who will ultimately sign the contract has a responsibility to really understand what is in that contract before they sign it. And if all they've got is the kind of complicated financial model, they won't really be able to understand that easily, because it takes at present several weeks' work to really understand what is going on in that model. I think this committee has got a responsibility, and I think the Scottish Government has got a responsibility to set up the systems that will make the system work better. If we could go back to PFI, as I said, in the original days of PFI, the Treasury specified an interest rate of around about 15% as being a reasonable return on the subordinate debt and the private, the risk capital on the project. But they didn't look to see how that was being earned. They assumed that it would be earned on a flat profile, and they argued quite vehemently with us originally, oh no, but that is paid in a flat profile, it's like a mortgage, it's fine. Well, if you looked at the financial projections where they hadn't done, you'd have seen that it wasn't being paid in a flat profile, and that there were huge potential secondary market returns being built in, and that was obvious before should have been obvious before the contracts were signed. All I'm saying is that some indicators which should be produced, there'll be approximate indicators, but they'll give a very good idea to everybody concerned whether there are potentially huge secondary market returns here. The secondary market itself, there's nothing wrong with it. In fact, it was regarded as one of the good aspects of PFI to begin with, because it would enable the private sector investor to get the capital out at an earlier stage and mean a more liquid market. And there's nothing wrong with that logic, provided that the potential returns which they're picking up are not obscenely large. And they were obscenely large in the early days of PFI. And when you look at the projections for hub projects, they are fairly large for hub projects. I mean, when I was looking at the three models I analysed, I was reckoning there's probably a return of something like 8% of capital on a sale early on in the project life for one that was going well.
I think the point I'm trying to get to here is, you say we all have a responsibility, which is fair enough, but if there's not one point who is responsible for a particular project, shared responsibility will mean we all tick our boxes, but we don't necessarily get the right overall answer. I'm trying to see who should be looking at this whole project and taking the responsibility for everything working.
I think it's responsibility for different aspects of the system. I think this committee and the Scottish Government has responsibility to make sure that the mechanisms are there so that I would say appropriate indicators are available at an early stage before the contract is signed. And then it's up to the public sector client to look at those indicators, and it's up to SFT to look at those indicators and to say, no, that smells wrong. There's an excess. It looks like there's excess return here. We won't sign for that.
So you're saying the public sector client, maybe?
Yeah, in any of these projects, the authority, the public authority that signs the contract is the one that has following the public pound, that has the duty to get the best value. We support that absolutely at programme level by we have standard forms of contract that make it easier to procure these things, and we provide some central support. As Jim suggested, and we published a lot of the models. We also have in the past helped authorities procure the right advisory support, because I think that, as people have said, these are quite complicated financing arrangements and legal arrangements and technical arrangements. So it's important that any authority that is entering into an arrangement like this is properly advised by financial advisors, legal advisors and technical advisors who understand what is going on and are able to analyse properly the tenders that come back, including the financial models associated with those tenders. So procuring authority primarily supported by the right advisors, which we are absolutely there to help them get in place and to support them with standard documentation things through the programme level role.
So does that work?
Yeah, I think it does, yeah.
I must say I'm a bit sceptical. I mean, Peter was in a sense talking about the benefits of competition and almost saying relying on competition to make sure a reasonable deal here. But the market is actually thin. And if you look at the documentation about the MIM model, one of the things that the SFT document on that says is that to more or less we have to have large complex projects to attract bidders at all. But if you're in the business of having large complex projects, you're not going to have many bidders, and it's very difficult to understand what is actually going on and what's concealed in there. So you cannot rely upon competition to make this process work. It didn't work with PFI, and I don't think it's going to work with the things like NPD and MIM.
Okay, thank you.
Okay, thanks, Bill. Colin Beattie.
Thank you, Peter. We've been talking about monitoring and reporting and so on, but what actual consideration has the SFT been given to any particular indicators that they would be proposing to look at to bring in to assist the quality of monitoring?
There's a number of different ways that we look at. We've talked already about the published unit charges, which show the cost every year and show the procurement information. We also publish the contract models. We've also, since the Audit Scotland report was published, taken on board their recommendation about monitoring the changes in ownership and recording those. So we've now published on our website the list of investors and funders into each of the Hub DBFM projects and the NPD projects. So that's just a couple of examples of the information that's published and tracked.
Mm-hmm. Now, Audit Scotland said that monitoring of secondary market transactions would help in assessing whether value for money has been achieved. How feasible is it to actually carry out ongoing monitoring of secondary market transactions?
As Kerry's just said, we monitor now and have published the equity ownership of all of these projects on an annual basis, so we do update that. We can't get the detailed commercial position behind any of the transactions that have gone on in the change in ownership, because that's a matter between the buyer and the seller of those instruments at any point in time.
So all you're really able to track is the ownership?
Yes.
There's no way to find out what sort of levels of return are there in the market?
Well, there's a lot of complexity in the investment market, as you know, and there's different owners at different levels. So ultimately, as we said, quite a lot of these investments are held by pension funds, and pension funds buy into different infrastructure funds or funds of funds. So there are lots of levels at which there are transactions occurring in the chain to the ultimate owners and the beneficiaries, who may be pensioners in the end, frankly. And we can't access the commercial details of all of the levels of those transactions, no.
Doesn't that create a difficulty? I mean, Jim Cuthbert, you were talking about having established levels of returns for investors in the secondary market. How did you manage to achieve that?
Well, I think it's fairly well known in the market roughly what people are paying in the secondary market. I mean, within a percentage point or two, there seems to be a general general knowledge of what's going on.
Sorry, just jump in there. There may be a general knowledge, but where can we find out the information? I mean, people like you may have some kind of knowledge of it.
But what I'm saying is you don't need to have an exact idea. All you need to know, as I said in the example I gave earlier on early PFI, we were working on an assumption that the pension fund would be paying about 8%. And I think this PFI investment company were assuming 9%. But that difference is irrelevant in terms of working out the order of magnitude of return multiple that the investor will be getting when they make a secondary market sale. But the other point I would make is that it's actually not that useful to monitor secondary market sales as they occur, because that's this is going to happen probably 4 years after the contract is signed. You can get an idea before the contract is signed of what the likely profit would be on a secondary market sale, and that's what you should be doing, and that would enable you to decide whether to sign the contract or not. That's worth doing. Monitoring secondary market sales will enable you to say, gosh, we got it wrong. And that's the sort of thing. There was an academic called Whitfield looked at PFI secondary market sales and worked out that the average annual return on PFI schemes for secondary market sale was being made was 28%. That's good, he could do that, but that's after the event. You can then say 4 or 5 years down the line, we were wrong with that policy, but you could have said that before the contract was signed, that this was the potential level of return that's going to be made, and you could have done something about it then. So to my mind, it's essential that you do your indicators and you do these calculations beforehand, and guddling around afterwards is just telling you that you've gone wrong 4 or 5 years ago.
But if you're going to base any sort of policy or financial decision, you're going to base it on hard facts, on a source that you can rely on and understand. If I'm not taking you incorrectly, you're saying you sort of find the market level from contacts in the market, as opposed to actually having some sort of an indicator that you can look at, get your hands round and use.
All I'm saying is that you can take the contract for a particular scheme, you can look at it, and let's suppose that the the return on subordinate debt is 10.5% in the projections, which it would be in a hub scheme, and then you can say, supposing that on completion of the construction phase, the subordinate debt investor were to sell that in the market for 7%, what sort of multiple could they make of their original capital? Does that look excessive or not? Now, you're not saying that it's going to be 7%, but you're getting an idea of the potential return they could make, and you can form judgments in that. And your judgment might be, well, it doesn't look as if the competitive process is working very well here. We won't sign that contract, or we'll go back out. Or your judgment may be more broadly about the whole policy. If that's the sort of potential return that people are making, maybe we'll go ahead with that scheme, but we'll reconsider this whole private finance policy. These are the sort of judgments which you should be able to make on the basis of indicators which you can make, which you can calculate fairly readily from available information. Remember, the financial projections are serious documents. This is a serious view by the person undertaking this project and risking their capital on what this will look like if things go well. So you can found a lot upon them.
Just coming back now to the SFT again, there was information that was promised to this committee in relation to the weighted average cost of capital and internal rate of return. We don't seem to have received that. Is it possible for this to be provided along with the major capital projects updates?
Yeah, we did write to you in 2018 with the information, September 2018, with the information that we believe had been requested at the time. So I apologise if the committee feels that there's information.
There was an update promised.
And we've said that for the weighted average cost of capital and the IRR, we'll publish those now as the average and the scheme by scheme for the projects that are out of the confidentiality period, and we'd be very happy to send a copy of that onto the committee.
Thank you. Thank you, Bina.
Okay. Yeah.
Give you the update figures just now. When we last reported, it was 4.74% for the weighted average cost of capital and 5.93%, and those averages have moved on since a number of further deals and the final deals have contracted. So the weighted average cost of capital is 4.69% and the project IRR is 5.86%.
Right, thank you. I'm going to go to Willie Coffey now. Willie.
Thanks very much, Convener. I wanted to look ahead to the future, to the mutual investment model that the Scottish Government is considering using, and expect that a lot of the discussion so far will still be applicable to this. But as I understand it, the Welsh Government are using this model, and it was just initially to ask both Peter and Jim just what your impressions of the application of that model have been, how successful have been in Wales, and perhaps just to discuss the relative merits of the MIM model as you see it. Thank you.
Peter.
Yeah, I'll start off and Kerry will maybe jump in, but we published advice to Scottish Government last year that the mutual investment model as adopted in Wales would be the most appropriate form of privately financed infrastructure investment, should that be needed to deliver additionality that the Scottish Government was looking for in overall infrastructure investment. And the model has been used in Wales. It has been very challenging for the teams there, I know, to go through the process with the Eurostat to get classifications for those projects, which is critical to allow it to deliver the additionality. But they're currently they're through procurements now on a road where they have a preferred bidder, I think, and for some schools projects. And Kerry might know more about the detail of the implementation over there.
Well, just in terms, both the schools project and the roads project are now at preferred bidder stage. Actually, the point I was just going to make, just in relation to MIM, in Wales, we spend quite a lot of time talking to the Welsh Government about it as they've gone through that development process to understand how they've approached it, and also in discussing the contract with colleagues there, and also with ONS. So that's helped inform the options appraisal that we published back in 2019 on what a technical solution to fit with the current Eurostat rules, and how that would work for private finance should government choose to use that route for investment.
I have no knowledge of how it's actually operating in Wales. When SFT published their option appraisal of the MIM model, they agreed that it would be more expensive than conventional public sector procurement. I published a note on it. I think the committee had a copy looking at the SFT document, and I argued that in fact SFT had probably understated the extra costs that would be associated with the MIM model. There were a number of reasons for that. One was because of the likely lack of competition on MIM projects. I mean, as the SFT document said, they would have to be fairly large and complex projects to attract any interest in the market. But large and complex projects are an opportunity for the tenderer to build in excess fat. One other thing I didn't like about the SFT appraisal was that they assumed a flat profile of payments on subordinate debt, which is extremely unlikely. It's likely to be end-weighted, so that for that reason they're likely to have understated the potential secondary market return for MIM investors. So, I think MIM is going to be more extensive, but is likely to be significantly more expensive than was conceded in the original SFT document.
Okay. Willie, do you want to come back on that?
Yeah, very interesting. When would we be likely to see the impact of say the first MIM project that we embrace? Are we likely to approach it in that way, Peter? Are we going to appoint one particular project, for example, and see how it goes, or are we going to throw all our eggs in that basket and finance a number of projects using that model? How is it likely to pan out in reality?
Well, as for the previous kind of projects I discussed, the decision on the financing route for individual projects will be one for government to take. We've done the analysis that demonstrates that is the route that, should we need to use private financing to deliver additionality, would be the best to use. And we've said the sorts of projects that it would be suitable for, which are similar to the ones that I talked about previously. As Jim said, the larger projects do work better for that sort of financing. And the way that we went about comparing the costs of different procurement routes did have some simplifications in, but the overall factor that we think is really important for everybody to understand is the whole life cost of an asset bought through and financed through different routes. And in the report that we said, and Kerry will have the numbers to hand on that, but it's the ratio of how much you have to pay over the whole life compared to the cost of the asset. Kerry.
We were keen to set out in a way that that we have seen it reported in the press, I guess, as well, just in terms of the whole life cost of taking that route versus the capital cost, and that those types of figures have been quoted before. And so our analysis showed that clearly if you just pay for the capital, you pay for the asset up front, that's one. If you pay for the asset with your government capital and you maintain it in the same way as you would maintain something that had been privately financed under a design, build, finance, maintain contract, that would be 1.5 times the original asset cost. If you were to use public finance such as PWLB, that would be between 1.9 and 2.6 times the original cost of the asset, and that range to take into consideration a move in interest rates. And if you were to use private finance, it would be between 2.6 times and 3.3 times the original cost of the asset. So as Dr Cuthbert says, absolutely, we all recognise that the private investment option costs more, and that taking into account the cost of the of private debt, and also the fact that it takes into account that lifelong risk and maintenance costs across the piece.
So are you saying that the MIM costs more?
Private finance costs more rather than that MIM costs more than previous routes for private finance.
You're saying MIM is cheaper?
MIM's broadly analogous with the cost of under non-profit distributing or hub DBFM or MIM. The sort of ratio is around about the same for all of those different routes, but all of them are more expensive than had public finance been available to deliver the project.
Right.
Just to repeat the point I made, I argued in that paper, which I think you've seen, that SFT's estimates underestimated the actual costs that will attach to MIM.
We've seen that, yes. Willie Coffey.
Yeah, thanks again, convener. I'm listening very intently. Could Peter just to clarify, is there any control ultimately over profits that can be taken under this MIM model or not?
So MIM is a profit sharing approach, whereas non-profit distributing was a profit capping approach.
Right, that sounds to me as though there's no control.
Profit shared between who?
Sorry, yeah, under NPD, there is an absolute fix on the return to investors across the lifetime of the project, and that's one of the things that was found by the Office for National Statistics and Eurostat to be incompatible with the private classification that we need to deliver additionality of investment. So the MIM model that we've suggested would be the best available route in the future does not absolutely cap that level of return to the investors. It's still bid in the market in competition, but if there are any increased profits made in the future, those would be shared between the public sector party that we've suggested would invest in a MIM project and the private sector majority investors in the MIM project. So there isn't the same absolute cap as there is under NPD, but there is a sharing of any returns made between a majority to the private sector investors and a minority to the public sector investors.
Okay, Willie?
Okay, thanks again for that. Are there any other models out there, Peter, Jim, that we could embrace? I mean, is the Scottish National Investment Bank a possibility here to use that model to fund projects like this, or are we basically, is this currently the only show in town?
So there's definitely a hierarchy of cost involved as we've set out, and the government, I would expect, will use its capital budgets first and any borrowing powers available to the Scottish Government. There are then arrangements that we've developed for schools in the future, working with local authorities to use the local authorities' own borrowing powers at the Public Works Loan Board to finance projects. And then there is the private financing approaches. The Scottish National Investment Bank, as I think you might have touched on in the last evidence session, has to lend to private sector entities. So it's not really best suited to delivering public infrastructure. It might well be able to invest in private infrastructure and housing assets, for example, but it's not best suited for investment in roads and schools and hospitals and things that are primarily public sector assets. And obviously the Scottish National Investment Bank's investment priorities will be something that they will set up in line with their missions.
Okay, thanks for that, Peter. Thanks, Camilla. Thank you.
Can I just
Thank
make
you.
a quick comment?
We'll just hold on. I want to bring in other members because we need to get through this. So Neil Bibby hasn't asked anything. Neil, have you got any questions?
Yes, please, convener. Thank you, convener. I want to ask about the Learning Estate Investment programme and the changes to that, with the councils funding the construction costs and the Scottish Government picking up maintenance and upkeep costs. Could I ask the Scottish Futures Trust what information is available on how the Scottish Government payments for maintenance will be agreed? Will agreed maintenance costs cover the full 25-year period of the school life cycle? And how can costs be predicted for such a long period, and what account is taken of factors such as inflation and energy costs?
Yeah, Kerry.
So the Learning Estate Investment Programme, as you've described, is funded up front by the councils. The Scottish Government will provide revenue funding over a period of 25 years, which is paid out on the evidencing of delivering certain outcomes which are consistent with the National Performance Framework and the Learning Estates Strategy. So that revenue funding supports delivering ongoing buildings in good condition, an energy efficiency target that can help see us towards our net zero targets, digital enhancement and community benefits. So whilst it's been described in the question as being linked specifically to payments for maintenance over the years, it's a much wider basket of outcomes that the funding is targeted to support. And in terms of looking, so there is a lot of evidence and information now from the types of the programmes that we've been talking about today about whole life costs, and that was what very much this programme was designed around, about looking at that whole life cost, so paying for a maintained building over time rather than simply the upfront cost of the asset. So the mechanisms as to what level that should be set at, and also that should that outcome not be delivered, how that is tapered down, has all been set in discussion with COSLA and with local authorities who've been part of the group who've designed the Learning Estate Investment Programme.
Neil.
Could you, thanks for that answer. Could you maybe expand a wee bit more on how if the maintenance costs, for example, are higher than anticipated, who would bear the risk for that? Would it be the councils or would it be the Scottish Government? An alternative, maintenance costs are lower than anticipated. Could councils redirect funds if they were lower than anticipated?
So the risk for delivering the outcome sits with the councils. So that includes maintenance as well, yes. But as I say, that mechanism and so on has been discussed and agreed with COSLA and local authorities.
Okay, and lastly, there's obviously a theme about transparency here. What information will be made public to support scrutiny of the schools investment programme and the outcomes of that?
I think just in terms of the programme, it has announced its phase 1 projects and is in the process of setting the funding arrangements around those, and that I was determined not to talk about COVID, but in a way some of the timing for that, council's attentions have been clearly busy and government's attentions on different things, so I think there is still work to be done on exactly what information will be made available, and that's something that will come back at a later stage.
Okay, thank you for that answer, and thank you, convener.
Okay, thanks, Neil. I'm going to go back to Alex Neil if he's got any further questions. Alex?
Yeah, thank you very much indeed, convener. Can I just, a housekeeping point, first of all, can I just check with Peter in relation to Eurostat, because obviously the intervention of Eurostat over the last 2 or 3 years has been fairly crucial in the need to change various things, everything from the status of housing associations right through to how SFT works. Will these rules still apply after we leave the European Union at the end of this calendar year?
I think there's a whole bunch of things that are uncertain about what rules and situations will apply after the end of the financial year or not. So we would expect that the Office for National Statistics will take on a set of rules very similar or identical to those that have been applied in the past. And so we will look to ONS, at least in the first instance, as we do just now, for their guidance on these matters.
Peter, is it? Wait and see, is it?
I don't know the answer at the minute.
Right, okay. Can I just go back to the, I think there are two clear messages coming out of here, Convener. One is that the cheapest way to fund private investment is through the use of capital. The second most expensive way is to borrow the money through the Public Works Loans Board or the National Loans Fund or the Bank of England, where the UK government is borrowing at 0% interest. And the most expensive way to do it is by involving private capital in the projects. Obviously, given the limitations in our borrowing powers and our taxation powers, we're probably, for the time being, going to have to continue to use these powers in terms of MIM or whatever projects we move forward with. But two questions arise. First of all, do we know where we're at in terms of the planned increase of £1.6 billion a year in infrastructure investment, and how much of that will be raised through the Scottish Futures Trust across all its programmes? Do we have a figure for that? And I'll come to my second question after I get an answer to that one.
The Scottish Government's not yet published its infrastructure investment plan, which we expect to be published during September sometime.
So you don't know yet how much of that you're expected to raise, Peter?
We don't know which projects are going to be procured under which approach until the infrastructure investment plan has been published, and there might be some more analysis of individual projects needed following that as well.
I think the plan is being published next week.
Right, okay. So my second question, which is the wider one, and that is under MIM, can I just go back to, because this relates to them identified with the hub and the non-profit distribution. Although MIM is based on a shared approach between the private sector and the public sector, if the private sector decides, and will it have the right to decide without approval from the public sector partner, if the private sector partner decides to sell their share of the business to a third party, will the public partner have any say in principle over whether they can do that, and if so, in what terms and conditions? Excuse me, in terms and conditions.
Peter, do you know the answer?
We don't expect the public sector to be able to control the ownership of the private sector's share, because control of what happens in those in the project companies is something that the classifiers are very interested in. So if the private sector investor decides to sell their investment on in the secondary markets, as we talked about already this morning, that will be a matter for them.
Right. So that comes back. Well, that comes back to the point that in MIM, we're not solving this problem of how do we prevent excess profits being made in relation to selling into the secondary market. So we're back to this issue and it seems to me we've got two basic options which are not mutually exclusive, i.e. we go down Jim's road of building in some additional calculations at the beginning so that we know what the upfront, what the parameters are financially in terms of selling into the secondary market, or we put something in the contract that gives some kind of cap on excess profits being made if the private sector is selling into the secondary market. Now, we know that we can do Jim's in principle. I know SFT don't think it's necessary or desirable, but we can do Jim's proposal in principle. It seems perfectly sensible to me. It doesn't cost us anything and can save us a lot of money. But would we, under the legislative framework in which we're operating, Peter, would we be able, either through SFT or in any other way, would we be able to place some kind of contractual arrangement as part of the contracts with the private sector partners to put a cap on any excess profits they make in selling into the secondary market, or indeed, if they do make excess profits, to pay a share of that back to the public purse?
We don't think that will be possible because of the, as I said, the classification rules don't allow controls or capping of the profits in that way. We also, I suppose, would say that the cost of the finance as part of the cost of the design, build, finance and maintain of the asset was set from the outset in competition, and if a party that takes the higher risk at the early stage then sells to a party who wants and values a longer term stable cash flow associated with the operational phase, then that is a market operating the secondary market, we call it. And I suppose what concerns me is we would judge the overall cost, as I've said, the unitary charge paid over the life of the asset as the most important factor in competition. And I'm not sure that we'd be in a position to make a judgment as to what an excess profit might be in a secondary market transaction or not, and what we would be able to do about that at that bidding stage, when we're focused on the best value to the public purse, which is the whole life cost of the asset paid through the unitary charge.
The point is about the value to the public purse, though, Peter, is if you did Jim's exercise before you signed the contract, and it showed that as it was proposed at that stage, you could reduce the price to the public sector to prevent excess profits, but enough for them to make a reasonable return if they sold into the secondary market. And that's the whole point of Jim's proposal, I think, is that you would have the information to make that decision if you so desire to make that decision. I mean, at the end of the day, there would be a commercial, because obviously your concern might be that people might walk away from the bidding and you'd be left with nobody to do the job. But the point is, at least you then know what the options are. Is that not the point of Jim's proposal?
Yeah, there's a whole range of it.
Once you've signed the contract, I think the point here is, I think from what you're saying, Peter, which I fully accept, is once you've signed the contract, there is no way that you can control the sale into the secondary market and the making of excess profit, however you define excess. But there is a preventive way of doing it. If you had the information, additional information, as part of the consideration of whether to sign the original contract or not, if you had the information Jim's proposing, you then at least know what you're getting yourself into.
And my view on that is that the cost of finance is one element of the cost of the design, build, finance and maintain of the asset that leads to the whole life cost. And we evaluate that as the total cost of the asset over its life cycle. And some bidders might have a higher cost of finance and a lower cost of construction. Some might have a higher cost of construction and a lower cost of facilities management. And the important bit for obtaining value for the public purse is the unitary charge over the whole life of the asset, and that's what the competition for these projects is generally based upon, along with an analysis by financial advisors of the financial models that looks at all of the aspects of the cost of finance and all of the aspects by technical advisors on the other costs involved. So I'm not sure that a single another digit that would be an MPV number would assist in that assessment of the life cycle value that we need to do at the stage of a procurement.
Can I just come in there?
But surely from the government's point of view, I mean, the government doesn't want people making excess profits out of taxpayer investment, which is what has happened in the past on occasion. And surely, therefore, it's reasonable. I'm not saying it's necessarily the crucial factor that would decide whether you sign the contract or not. But surely it's useful to at least have the information because I know if I was still the infrastructure secretary, I'd be very uncomfortable about consciously signing a contract where people can make a killing effectively from the taxpayer.
Jim Cuthbert wants to come in.
Can I just say that what Peter's saying, I think sounds awfully like, to me, awfully like the original heresy of PFI, that in a sense, with the original PFI, the public sector didn't want to know too much about the detail of the contract because they felt that the private sector had a sort of magic, and if you probe too deeply, that magic would disappear. And that was proved to be an utterly disastrous policy. I see no reason why you lose by knowing extra information. In fact, you gain. And it can be done at no cost. In fact, it can probably be done at a saving, because if you specify that certain indicators should be produced, it saves you the public sector the cost of having to analyse those contracts themselves. And detailed analysis of a financial projection is in itself a costly and time-consuming exercise. So I see there's no downside to this extra information, but plenty of upsides. And it potentially strengthens the bargaining hand of the public sector in a way that has not been able to exercise it in the past.
Can I just ask one final question, just following up, because I was just going to make a similar point to what Jim said, and it's directed to both Jim and Peter, but I suppose mainly Peter. If the private sector partner knows up front that you're looking at the potential for excess profits and it will be a factor in your consideration, does that not then incentivize them not to build too much fat in, so that they make excess profit in the secondary market? Whereas if you're explicitly not looking at this and not taking it into consideration, they might well think, oh well, we'll get a bit of fat in here, we'll get a bit of extra profit in here, we'll make a real bob or two after the construction period, because they're not going to be bothered about the excess profit.
I don't think I said that we weren't looking at the cost of finance as part of the overall package. We absolutely, the procuring authorities and their advisors and SFT look at the total cost of finance as part of the package of design, build, finance and maintain. And all the information that we can get about that is useful. The financiers are incentivized to offer the lowest possible cost of the financial package as a whole, because it leads to the lowest possible cost of the design, build, finance and maintain, which is what we evaluate. So all of those market incentives are there, and collecting data is all useful. I'm just not sure that this particular measure would allow us to make any different decisions during a procurement than if we did than the generality of the analysis that's already done by the advisors and the authorities going into this procurement phase, which it's a really important phase, and that analysis is really important, and a lot of it is done by the financial advisors and the procuring authorities on every contract. But Carrie,
can I just make one small point on that as well, which I don't think has come up during the discussion? The project financing structure over 25 years, and the way that in order to secure long-term debt from the market, the structure is that and also to ensure that your investors are right the way in it and are incentivized to perform to the contract that they are performing for the client, means that their capital has to be in right to the end. So there is a natural part of this structure and the length of it to incentivize the risk investors to be there right the way to the end and be ready to hand back and make sure that should there be any kind of issue with the facility and so on, that investment is there to be drawn on. So part of the structure itself is what is why that profit is, or the return is in there until the end. So that was just one of the things that hasn't come up yet. There is a natural part of the structure which is to keep it in until the end. You hold the contractors and the investors tools to the fire to make sure they perform to the contract to the end.
But hold on, that's nonsense. Because if the equity has been sold to a pension fund is looking for 6 or 7%, their risk capital is not until the end. Secondary market sales remove the risk capital and put it in the pockets of the original investors.
The contract hasn't changed and the performance hasn't changed and the investor is still there.
Yes,
and if the investor doesn't perform, they will lose their investment.
Pension fund who thought they
Right, if you could just stop having a private ding-dong, that would be useful. Alex, have you finished your questions?
Yeah, I think so. I think it'd be useful though if we got a list of NPD hub contracts where people, I know we don't know the detail necessarily of what they sold their share for, but it'd be useful just to get a list of where investors have gone to the secondary market since it was introduced, Graham, just to see how widespread the practices of going to the secondary market. I don't think we've had that information.
We publish that information. We'll happily send it to the committee.
Okay, thank you very much.
Thank you.
Okay, I just want to check around the members. Any further questions? The other members who are joining us remotely? Nothing. Okay, so can I thank the witnesses today? A very interesting and useful session. So Jim Cuthbert, Peter Reiki and Kerry Alexander. Thanks again, and I'll move the meeting into private session.